Hello and welcome to the Jake and Gino podcast. I am flying solo today. Jake, where are you, brother? I miss you. But anyway, this is going to be a good conversation, Jake. Just to let you know, we're going to talk a little bit about emotions and about money. So I don't know if you'd want to be part of this conversation. We're going to find out because I love this topic and I love this guest. Chris Miles is the cash flow expert and founder of Money Ripples, known for helping entrepreneurs and investors create financial independence without relying on traditional retirement plans. A former financial advisor turned passive income advocate, Chris has been featured in U.S. News, CNN Money, and hundreds of podcasts for his unconventional strategies that actually work. He's helped his clients collectively free up tens of millions of dollars and build steady streams of income fast. Today, Chris shares how to take control of your finances, build lasting wealth, and create a life of freedom well before the age of 65. Welcome to the show, Chris. How you doing, brother?
Doing great. I'm glad just to be on the Gino show today.
Well,
you don't need Jake.
I got you all to myself. But listen, one thing that stuck out in the bio for me, I don't know why, a former financial advisor. Talk to me about why you're former and, in your life as being a financial advisor.
Because I was a sinner and I repented of those bad ways of being a financial advisor. That's why.
Talk to me about the sins. What were the sins?
Yeah. So when I never actually intended to become a financial advisor. I went to college with a focus of going into business consulting, right? I was going to become a business consultant, kind of like the Bobs. If you ever watched the movie Office Space?
Yes.
I wanted to become like the Bobs, right? And go in, tell the companies what they're doing, how they're treating their employees like crap, walk out with a big paycheck. But I figured if I'm going to do that, shouldn't I have real life business experience? I shouldn't just go out and just get an MBA and then tell people what to do with their business when it's all theory. I wanted real life experience like my dad taught me. So I dropped out of college just to take a 1-year sabbatical. And I was trying to find some business to start. And the first one that came up that was kind of intriguing was being a financial advisor. Because I figured worst case, I learned about money for myself. Even better, maybe I could even help my dad, who was like this super penny pinching saver, who believed he would never be able to retire. He thought he would die working, right, from the stress of the job. So I said, man, worst case scenario, I might be able to help myself and my dad by doing this business. And after I got into business, I really loved it. In fact, I never went back to finish my degree. I stayed dropped out, and I went down the path of being a financial advisor for about 4 years. And during that time, I drank the Kool-Aid. I was the guy that was in the salesman in a suit, right? I told you to set it and forget it. You're in it for the long haul. Even when the market goes down, it's okay. And by the way, I came in right after like 9/11. So it was a great time to become a financial advisor. And so I'm telling people, like, just keep packing money away. And I believed it myself. I was trying to live a cheap life and pack all that money away, just like my dad taught me to do. Well, 4 years in, I go sit down with my dad. He says, Chris, are you going to advise me at some point? And so I sit down with him and we look at all of his finances. And, he's like, Chris, I'm 61 years old. I want to stop. Like, I don't have to keep working this job anymore. And so I see that he paid off all of his debt, including his mortgage. So he's 100% debt free. He had been packing money in his 401k. This guy was like Dave Ramsey's poster child, right? Before Dave Ramsey was Dave Ramsey. And then as I looked at all those numbers and stuff, I said, Dad, here's the deal. If you want to retire today, you're going to have to die in about 5 or 6 years because that's when you're going to run out of money. Okay, what do I do, Chris? I don't know. You did everything right from what I teach as a financial advisor. You've been, packing it away. You've been saving to your retirement accounts and mutual funds and everything. You've been getting your company match even. You're debt free. It should have worked. And I was lost for answers. It was just a month later, I'm talking with a friend of mine and he says, well, Chris, how many of your clients are actually financially free where they don't where they're not worried about money? I said, well, they all worry about running out of money too soon or outliving their money. Okay, good. So none. Got it. How about this, Chris? How many of you guys as financial advisors are financially free, not off the commissions you're earning, not off the business portion, but actually doing these same investments you've been recommending? And I knew right there he had me because there have been guys working in my office since the 1970s that they couldn't even retire themselves. And I said, none. There's your problem. And he got me kind of going down this rabbit hole because he actually was a guy trained to be a financial advisor, but then he quit off my team to go do this crazy thing called real estate investing. You might have heard of it, right? And so he was telling me how he and his dad have partnered on some real estate deals, doubling his dad's income as a professor at the university in our area. And I said, that's insane. That's too good to be true. No way. But as I started to really dive into it and realizing it wasn't about saving and slaving away, right? That's the way we've always been taught. It's just pack it away. You're in it for the long haul. When the market goes down, just stay in longer, even if it means another 10, 15 years, which is what happened to my dad. My dad had worked another 10 years or so before he finally retired. He had to work 50 years to hopefully live the last 10 years of his life, right? And of course, as I started to realize this and break free from this accumulation mindset and more to a cash flow passive income mindset, I was able to take my own situation and later that next year, when I was 28 years old, able to retire, and then I was like, well, crap, that was easy. How now what? And that's where I eventually in 2007 came out of that quote unquote retirement, because you get bored in retirement if you just do nothing. Came out, started teaching people how I did what I did.
It's interesting because at retirement, most people don't have a net worth problem. They have a cash flow problem. And I think it's interesting because I was taught that way as well. Son of immigrants, I love to save. That's my, I guess, my archetype or my money persona. But saving is accumulation, which is great, but then it becomes scarcity because you're afraid to touch the money. And it's great. I think Dave Ramsey's principles are great, but let's dive into why you have those issues. There's a reason why everyone has issues with money, and accumulating it, saving it, paying down your debt may be a temporary solution, but that's just a symptom. Where's the actual problem lying into it? And I love what you talk about with cash flow. Let's focus on cash flow. And one thing before I ask you the next question, the problem with financial advisors is they're just have a limited toolbox. Let's look at alternate investments. Let's look at possible whole life. Let's look at possibly, which is an asset, not an investment for all you financial advisors out there. Let's look at real estate. Let's look at possibly crypto, Bitcoin. I mean, because I think things are different. It's not just mutual funds and stocks and bonds. I think there's a plethora of different options for different investors out there. And when you retire at the age of 28 and you want to go back in, what are some of the things that you're teaching or you're talking to about financial advisors, and they're saying, "Are you nuts? Are you crazy?" Like some of the strategies that you wanted to implement or you wanted to share with them.
Oh, all the time. Here's the thing you got to understand, like you just alluded to, financial advisors are not people paid to make you money. Financial advisors are paid to sell you a very narrow suite of products, primarily stocks, bonds, mutual funds. That even expands to like annuities, maybe insurances, but that's it. They have this very limited, narrow focus. And so I used to think I was there to help save people, right? Like I'm going to help them be able to retire and live out their golden years. But when I realized it wasn't even working for my dad, nor even for myself, right? I was packing away money, hoping that by the time I was in my 40s, I would have $2 million. Why 2 million? Because I was always taught, people talk about the 4% rule. It's been bogus and debunked for years. And people still teach it like it's gospel, right? That 4% rule works if you're about 70 years old. It's 3% if you're hitting even in your 60s. And so for me, I thought, okay, by my 40s, if I can have at least $2 million, I can live on 5,000 a month or 60,000 a year. That's 3%. Well, here's the problem. That 5,000 was awesome back in the early 2000s. It's not awesome today. I mean, it's okay for some people, but it's not like it was then, right? It's like most people I talk to today want at least $10,000 or $12,000 a month, right? To feel like they're comfortable in retirement. That's the common number I hear all the time. Well, to do that, that means you have to be making somewhere around 120, 130,000 a year. Well, guess what? You got to have at least minimum $4 million to live on 3%. So that number has now doubled even for me in my late 40s, right? And that's one thing people don't understand. And if you're trying to do it, the whole FIRE movement, that's another one I get blasted for because I rip on those people. I call them out because the funny thing is I thought the FIRE movement, financially independent, retire early, were people just like me who did it. And I did it with real estate investments, right? From cash flow focused things. And we'll get to that in a second. But they're all about, no, you save up in mutual funds and you get as cheap, minimalist lifestyle as possible, pack away in your mutual funds, and then you live on the 4% rule, is what they taught. I told them, I said, listen, if you're trying to do it, retire early, it's a 2% rule because you would run out of money because people live longer and people, of course, there's inflation that's bigger. Just so you know, that 4% rule was created from studying 1926 to 1976. People didn't live as long and 1974 is when we're taking off the gold standard. Inflation has increased dramatically since that era. And so that's why it's a 3% rule, even if you're in your 60s, right? But 2% if you're trying to retire early. I got kicked out of a FIRE Facebook group because of this, because I said, this is the reality, and they didn't like it, right? And so I get blasted all the time. I get blasted about rates of return in the market. People think the stock market does 12%. It has not done 12% long term. It has averaged now, the last 30 years, it's just over 8%. That's it, just over 8%. Most people in 401ks, however, don't even get that. That's another thing. People are like, oh, I get the match to the 401k. It's the best thing ever. Is it? Because here's the deal. If you look at the Fidelity funds, right, the target date retirement funds that actually 86% of millennials will select in their portfolio, did you know the last 10 years, those target date funds underperform the stock market by 2.1%?
Didn't know that.
Here's the crazy thing. That doesn't include the 0.75% base fee that comes out in administrative fees, nor any other fees that might be tacked on depending on who you work for. So you might be lucky to really get less than 3% of the market. That means if you thought 8% average, you're getting more like 5. Did you know what that 100% match does long term? It doesn't give you 100% return like some people claim. It only adds about an extra 2 to 3% a year, which means that if you pick the typical retirement funds in a 401k, because they perform so poorly, all the match does is make up for the bad performance. You make basically what the stock market, you would have done on your own in the stock market. So all these little sacred cows that people don't like to ruin, like they think that the SP is the best way ever. The market always goes up and you should dollar cost average. But it's like, well, just so you know, if the market's always going up, we're not dollar cost averaging on the, going down, it's going up, but they'll tell you it's always a good time to buy, right? Even if it goes down, they say, well, buy more, it's on sale. But if it goes up, they're like, don't stop buying because it's going up. It's like brilliant marketing that people don't realize. We've been brainwashed for so many years that people will try to blast me on social media all the time on like YouTube or whatever and say, oh, this is BS. Like the stock market's the best thing in the world. It's like, you need to get out more. There is so much better than the stock market.
It's interesting. I'm going to take a couple of different routes with this because the first one is the financial independence, retire early. I did a podcast with MJ DeMarco probably 3 years ago, and we were just ripping on them because the whole idea is to save up all his money. And then when it worked 30 years ago, but nowadays a cell phone costs you $100. There's so many more expenses today that people would consider basic, that if you just want to go live in the woods, I guess it's okay. I guess it's a great lifestyle, but you
make your own toilet paper out of leaves. Yo, come on.
Yeah, that's what I'm saying. Health insurance, car insurance, you have dental insurance, you have there's so many different. I mean, you want to watch a freaking movie or freaking TV, you have to be subscribed to 15 different subscriptions nowadays. And it's great because that's what makes you prosperous. But if you're living on such a tight budget, you aren't going to enjoy your money. And I'm going to give you my
Don't get married, don't have kids.
Yeah, it may work for 0.1% of the population. If you're that person who likes to live by themselves and wants to deny themselves of a lot of pleasures, but say you're free, you don't have to have a job, and you want to live in the woods, it works for you. If not, but Chris, this is my whole theory about the stock market and the 401k. It was created back in the 1970s. We had defined benefits. They went into the 401k where they pushed it off onto the employee. Now, in their infinite wisdom, because they're smart at some things, they're for the most part, they're incompetent, the government, in doing a lot of things. But this one was genius to me. So you're creating demand back in the 1970s of having people put money into the 401k, while at the same time having people having to withdraw money at 70 and a half. So you're creating supply. So people have to buy and people have to sell. And they're also generating tons of tax money when people are actually retiring, because you think you got $1 million in your 401k when you're retired, you should have paid money on the seed, not on the harvest. Because now that harvest is not $1 million, it's more like $700,000. And then when people realize it, that they've been sold to, it's like, okay, the other one is the opportunity cost. You have all that money sitting there for 30 years, not being able to do anything. Meanwhile, these companies are using your money to make money. So to me, the conspiracy is creating this demand for stocks. And I personally think that's why the stock market has been bolstered, because there's so much demand for it created because people think they need to put money into a 401k. There's so many other alternatives to be able to put your money. I don't know if you have any thoughts on that.
Oh, absolutely. I mean, you're absolutely right. The 401k in the 1970s was set up for high paid executives. Why? because the top tax bracket was almost 90%. That's why. And so the theory was delay my taxes to a later date because if I'm paid such a high executive salary with the company, I'm probably going to live on less later on. That was the theory, right? And because there was such a drastic difference in the federal tax rates that they thought, okay, this makes sense. But you're right. The government, they knew even the 70s and 80s, they said there's a problem coming. We've been pillaging the social security funds. And now we realize these baby boomers are at some point going to want to cash in. And we've got to do something bad or we're going to run out of money fast. And so they did. They worked with Wall Street to figure out what to do. And they said, hey, let's open up the 401ks, not for top level executives, but for everybody. And this happened about 1985, right? So my dad was right in the early adopters, right in the 1980s. So he only had like 20 years to get his 401k matches, right? He was still saving money. He just didn't get the matches till later. But they're pushing it off onto the people, say, here, you do it so that we're not putting all the strain on Social Security, because that's what everybody was thinking, you know? Now, that being said, the one issue I also take with this as well is that, like what you just said, right, is our taxes, is it going to be better for you in the future? So I remember when I set up my 401k, this is when I was a normal corporate employee before I became a financial advisor. I was in college, I was working a job. I remember that HR representative in her 30s who said, okay, so here's the deal. The 401k is like the best thing ever. It's so amazing. And here's the thing, you're going to put money in, you're not going to pay tax on it, but not until you take it out in retirement. But it's okay because you're old and you don't really spend money. So you're going to be fine. And I said, well, wait a minute. Like, that doesn't make sense because every person I know as they get older spend more money, right? They don't want to get cheaper. And so her assumption was, and this is even Dave Ramsey makes assumption, right? You're going to live on 70% of whatever you live on today. Well, are you? Are you really? With inflation, is it going to be 70%? Like it's going to be probably more. And then they've already shown that once you get into your first years of retirement, you spend way more than you do the rest of your retirement. So you start hitting that money fast and early because you're trying to make all these transitions and adjustments. So to say, oh, I'm being a lower tax bracket, no, you're just delaying your taxes to a future date. Here's the question. The Trump tax plan, even the old one, is in effect. They're trying to get the new one in effect. The old one, by the way, the 2017 one, was one of the lowest tax brackets we've been in history since 1914. Do you think that your retirement, maybe in a couple, 10, 20, 30 years, whatever it is for you, do you think that taxes are going to be lower or higher? If they're going to be higher, why would we dare want to put money somewhere now, save on taxes now when we have our kids, we got home mortgage interest, maybe you have student loan interest and things like that you're writing off that now no longer is there. You have no more write-offs, and now you have higher income taxes, right? That's the thing. Like that's the flawed philosophy around a 401k is that there's so many assumptions that you think in a perfect world that somehow you're going to live a cheaper lifestyle and be happy. That may not be true.
Yeah, I agree. Some of these alternative investments, you talked about real estate. How are you teaching people, or when you see individuals, are they open to the idea that you may be speaking some truth, and they've been drinking the Kool-Aid and saying, "Wow, let me step back and take a look at Chris," because I know the topic of money is so emotional. It's like one of the last taboos we have, and it's very interesting. And if people don't understand, just look at your own situation. If you're listening to this, it's intergenerational. And if you don't break the pattern, it's like, why are certain areas of the country poor and they're still poor? And why do you see some families do really well with money and they pass on to the next generation? Not the money itself, the stewardness, the habits, the way they look at money, the relationship with money. So as you're listening to this, money's a taboo subject, and you don't buy, people don't buy low and sell high. They buy high and sell low because there's a lot of fear around money. And when fear gets triggered, you don't do things in a rational sense. You do things in an emotional sense, illogical sense. So that fear around money. So when you're talking to investors, do you see like the guard going up? Do you see them bringing in their own biases with money? How do you cut through that?
Oh, sure. I guarantee anybody listening to the show, if they've been brainwashed in that savor scarcity mentality, you already are feeling it. You've already felt it as we've been talking about this subject, right? But I'll tell you, more and more people are becoming open to it because so many people right now, they're like, listen, that stock market's done something in history it hasn't done before, which is it's gone almost straight up. Other than 2022, it's gone up almost straight up since 2009. That's going on into the 17th year, unless this ends up being a down year, which is kind of threatening right now. 17, like 16, maybe 17 years in a row, it's been going up other than 1 year. That does not happen in history. They call it the Wall Street waltz for a reason. 2 steps forward, 1 step back. It's usually 5 years up, 2 years down in the 7-year period. We've blown past that. We are way beyond it. So there's a lot of people right now that are more intuitive saying, I just feel like right now, this may not be the time to be in stocks. This might be the time to cash out of my stock portfolio. But the problem is, where do I put it? Because I've been taught this is the place. This is it. This is all I have. This is my only option. Every financial advisor I talk to says, this is it. Mutual funds, stocks, bonds. That's it. Maybe I could put into some annuities with some guarantees. Maybe I'll throw into a CD because the banks taught me about that. All of the marketing money goes into teaching you how to do this stuff. What opened my eyes, and by the way, I did the same thing. And why the reason a lot of people trust me is because they realized that I was a financial advisor. I was on the other side of the curtain. I saw the wizard. I came out and started saying, hey, that wizard's a fraud, right? It's not true. Here's a better path if you just follow the yellow brick road. And then what's interesting is, like, for me, 2006, when I started to learn about this whole world opening up to me of alternative investments, right? Real estate investing. Give you a simple example. If I go, I learned about hard money lending. Didn't even know that was an option, right? I didn't know you could actually lend your money to real estate investors. And when I realized, now they paid more in 2006 because people got a little bit frothy. But this concept blew my mind. Remember, I thought the 3% rule. If I had $1 million, I could live on a whopping $30,000 a year, live below the poverty line as a millionaire. I'm a broke millionaire, right? But that same $1 million, if I make 1% a month lending my money to real estate investors with real tangible assets backing it up, I'm making now $10,000 a month, not $30,000 a year or $2,500 a month. Then I have to pay taxes because I put it in my 401k, right? No, I could be making $10,000 a month. I mean, I'll tell you, like, I was on cloud 9 when I learned about this. Now, my dad had a hard time adjusting to that because he was hoping for something, but that was hard, especially when he had a paid off house, all that equity in his home. Here's the problem. Get your money out of prison. Every financial advisor will tell you, lock your money up in prison, lock up in equity in your house, lock it up in a 401k or IRA where you can't touch it. Think about it. So many people think that they actually are wealthy, but I hear the opposite. I hear so many people that are like the Dave Ramsey poster children. They've saved even millions of dollars in their IRAs and 401ks saying, I've got zero income coming from it. Just like you made that point earlier, Gino, like that income, that cash flow is everything. And when I show them, it's like, listen, you could actually be cashing out money now. So like when I had a guy from California, he had $1 million. I said, listen, if that million makes even 10%, that's $100,000 a year versus the $30,000 that his financial advisor just told him he could pull off. So it wasn't just me, by the way, talking about 3%. It was the financial advisor too. And so he came, he was looking for solutions. He was on podcasts like this and things like that, and found my Money Ripples podcast. And then he hired us. And then as we're working with him one-on-one, it's like, listen, you can diversify into things like multifamily. You can go to things like oil and gas. You can go, do things like get a couple duplexes or whatever, right? And so he starts cash flowing over $100,000 a year with that $1 million. Same thing. I mean, the same money, just working in a smarter way, focusing around income, not just accumulation. That's the big difference. Just as an update, he was on my show twice. I was privileged to interview him when he started, and then when he got to that goal when he was financially independent. And just a couple months ago, he passed away. And I think about how powerful that is, right? Because he had to shift his mindset around money. Coming back to your question there, Gino, right? Is that he had to shift from that saver mentality to something better. He went to what I refer to as an abundant steward mentality, which is the only one that actually works if you want to have true financial freedom. And so it's like, what's the highest and best use of my money? How do I get it to produce and create more? How do I edify with it? How do I multiply my all of the things I have in my life, blessings as well as my money, right? Versus just set it and forget it, save it, accumulate it. Don't pull out too much because I don't want to run out of money, right? It's that constant scarcity. You can never save enough. You can never pay off your debt fast enough. It's never enough in that saver world. Spenders, a whole nother scarcity situation that we all get too. But those savers, I mean, he had to adjust from a saver to a steward mentality. What I'm so grateful for is those 4 years he had of financial freedom. He was able to live life on his own terms. He was able to live the life he wanted. Even when he worked, he was doing things like for the Forest Service and doing little projects that way and whatnot. And literally just a few months ago, he was sitting at his desk. He had already actually battled cancer. He didn't even tell me he battled cancer, overcame it. He won. And then all of a sudden he's just sitting at his desk on a Monday evening and he just collapsed. He had a heart attack, and that was it. And that's the thing is like, we don't know how many days we have numbered on this planet, but a steward realizes that your days are numbered and you can just do the best with what you have right now. How can I get my money into production right now? Not set it and forget it, but how do I get it to work for me? So then eventually I don't have to work so hard for that money.
It's interesting. There's a few things I need to touch on what you're saying because it's important. And if you don't think Chris is telling the truth or you don't agree with his point of view, I'm going to say something that's going to piss a lot of people off listening to this. I believe in Chris because I don't believe the narrative that we've been told for the last 30 to 40 years from the government. They've lied about everything. They've lied about COVID. They've lied about health, the food pyramid, immigration, money, everything. They've lied about everything. And this is just another example. Maybe lie, maybe not tell the whole truth. I don't know where you lie on it. And I don't think this is a political spectrum. I think both sides of the story. There were no WMDs. I was a hardcore Republican. I believed that years ago. Now I'm like, wow, okay, I was lied to. And if you're an adult and you're listening to this and you're getting triggered, I understand because we all get triggered. But just take a step back, take a deep breath and say to yourself, and this is what I always say, follow the money. Where is the money flowing to? Climate change is another one. Is it man-made? I don't know, but I see where all the money is flowing to and they just want to take more of it. So I'm a skeptic to begin with. And same thing with the food pyramid. Who's lobbying to make us eat more carbohydrates when there's more people are diabetic? I'm just saying, follow the money. Same thing with financial planning with stocks and bonds. There's something called the self-directed IRA. About 8% of money are in self-directed IRAs. Why is that? Because the financial institutions don't want you to direct your own funds. So it's important. As you're getting pissed off and listening to Chris and listening to me, I get it. But just let that ease and let that calm down and let some of this information seep into you, because this, I think personally, may be life-changing if you're listening to this, because you may have been bought in to the system like I was and like Chris was. We were both disciples of the system. I was paying into a 401k, right? Even at my business, I had a self-directed and we were directing it for our employees. I thought I was doing great. I was saving a ton of money. I was living the dream until, wow, I woke up one day and I'm like, you know what? I got to work. That's 20, 30 years. I don't have any cash flow coming in. I've got one small business and one stream of revenue. That's not good, especially in today's economy. 50 years ago, worked great. Doesn't work like that anymore. I think '08 was a big seismic shift with the Great Recession and with the internet coming along and everything changing, becoming more global, becoming more expensive. That's my opinion, what happened back then. And I think it's just carried on.
Next
If I
could,
question.
can I pause on that one really good? Because I think this is the crux. What people need to realize right now is that you got to look for evidence, right? That was the one thing my dad taught me. He might also taught me to be a saver, a scarcity saver, but he also taught me some good things, which is look for proof, right? Don't just take people's word for it. He was of course at the forefront of the baby boomers, right? He was in the Vietnam War. He taught me to question everything. Gen Xers question everything, right? Let's admit it. We're the latchkey kids that said, "Screw you. We're going to figure out how to raise ourselves. We're going to figure this out," right? Well, when I started to question everything, I looked for evidence. I was like, well, shouldn't there be proof of people retiring well doing the traditional financial planning?
Great point. I love
Here's
that
the thing.
point. Yes.
Fidelity 2023 came, they have 800,000 people. Now it's about 900,000 in 2024. So let's just say there's 900,000 people that have at least $1 million in a Fidelity 401k or IRAs. There's 46 million account holders, only 900,000. Think about it. Only 2% of all Fidelity account holders have at least $1 million. And remember what we just said, if you live on 3%, that's 30,000 a year. That's not living. You usually need at least $2 or $3 million to have a comfortable middle-class lifestyle with that. This is why Transamerica did a separate study of those same millionaires, right? Those that have at least $1 million, and asked them, how do you feel about retirement? 35% of that 2%, 35% said, I think it'll take a miracle for me to be able to retire.
Wow.
So think about this. That means, and that's a miracle, right? Some other people might have some doubts. That's also in there. That means maybe 1% of people say, I feel good. I think I'm good. Think about that. 1%. That's like looking at Google reviews for a restaurant. You say, oh, there's that one 5-star review from that guy's mom, but there's 99 other 1-star reviews. And yet somehow we're still all supposed to want to go try that food. That's what we've been doing with financial advising. So when you look for that, and Gino, come on, let's be honest. How many people we know, and even if you're listening to this right now, ask yourself, how many people do you know that intentionally or even unintentionally became millionaires or multimillionaires buying real estate properties and holding on to them? Think about that. You listening right now might have become an unintentional millionaire, not because you were such a good saver, although that might have helped, but it's because you bought a property maybe 20, 30 years ago and you made a crap load of money off of it, right? That's the difference, right? Real estate has been proven to work more safely and securely with higher returns than the stock market, especially when you consider leverage and everything else. And so look for proof.
Chris, how do you build that financial foundation? Because I think that's the key, right? The key is obviously, as we're talking, me and you, we're both on the same wavelength. It really comes down to mindset, and it comes down to preparation and years of you doing this. So if you're listening to this and you're saying, you know what, I'm not really ready, I don't have the experience, where should I start? I think personally, everyone needs to build some type of financial foundation. They don't need to run out and start looking at assets and start looking at deals. Learn. I mean, where should they start to build that foundation? Because you don't want to build it on sand, because if you build it on sand, you see what happens, right? You want to build it on bedrock. So if something does happen, you can withstand it and you can continue to build your quote unquote empire, whether it's hard money loans, whether it's syndicating in multifamily real estate, whether it's adding to Bitcoin, whether it's buying gold, whether it's buying, investing in multifamily or single family homes. How do you start that financial foundation?
Yeah, it's tough because there's no one answer for everybody, right? Everybody's a different investor. As we worked with people one on one, which is kind of a unique thing that we do. Nobody's always the same. Like even when people ask me what I invest in something, but like they're probably going to do something different anyways, even if they know exactly what I invest in. And that's the case, right? And so the first thing is obviously if you're doing like this, you're watching these shows, right? I mean, this is why I have the Money Ripples podcast, just to help educate people on these different options and what are out there. So one, learn about the options, learn about this other world, focus on how do you get your mindset from that saver to a steward mindset, right? Where you start to look at money very differently than the traditional Dave Ramsey, Susie Orman type of mentality. Break away from that so you can be free, because that hasn't worked. We've already proven that time and time again, right? Even though they talk it up and there's so much big money, billions of dollars put into it to blast it in our faces by the Merrill Lynch's and the Goldman Sachs. All these people have so much money to tell you this is the only path. There's another. So learn about the other paths, like shows just like this, right? Then, as you're learning about this, start to build your network. This is the hardest thing to do and will take the most time. Is it's not just learning about the strategies. That's not too hard to do, actually. It's learning about who do you trust, who's actually someone that's capable. Can you find an operator that's been around doing these kind of investments? Not like they pivoted and they're doing something completely different they don't have any experience in, right? But somebody who's maybe been doing this for 15, 20 years. If they're doing multifamily, like great. Do they have a track record? Are they paying their people? Even if they didn't pay their people, did they find a way to try to make it work? Did they learn from those failures? I love when I hear operators say from like in 2008 or whatever, saying, yeah, I got burned at this time and I lost some investors' money. I'm like, great. What'd you learn from it? How'd you pivot your business and adjust it in a way so that now it doesn't happen again? That's what I love to hear. I don't want to hear from people that say, yeah, I just started doing, multifamily in 2022. Oh, well, great. Well, call me in 2035 and then we'll see how you're doing. You see if you're still in the business, right? So building up that good network, people have a good track record. They're not bad actors out there. They're not bad operators. They're not charlatans. They're actually people that are legit, hardworking people that have strong integrity. They want to make sure that you get paid. That's what I look for. And again, I'm coming from a perspective of a passive investor. I'm not an active investor anymore. I did that back in like 2006 through 7, and I hated it. I much rather give my money to people I trust. But again, you got to build up that network. And then the strategy, that does take some time. That's one reason why we even have our one-on-one consultings, because we want to provide all that, right? It's like, one, we actually provide one-on-one guidance. We're not investment advisors, but we can say, based on your money and what you're trying to do, you got an IRA. Could we self-direct it? Could we put it somewhere else? Where's the best investments for self-directed IRAs versus your cash on hand in the savings account, right? How do you get tax benefits? Which ones work better? And who could you be investing with that could be the best connection for you in that space? And then you can diversify into different places so that you make sure that you're not got all your eggs in one basket. And that's the real key thing. I mean, that's really why we try to, shortcut that so much because it's hard. I mean, it took me years to develop my own network. I can't imagine trying to do it on your own. And Google sucks trying to create a network, by the way.
On that note, let's take a quick time out. I love that. This episode of the Jake and Gino podcast is brought to you by Wheelbarrow Profits, the premier multifamily education community. Wheelbarrow Profits proof is in their results. Their members have closed over 86,000 units. That's over $5 billion in student deal volume. Are you serious about taking your real estate game to the next level? Do you have the confidence to take action? Schedule a call with the Wheelbarrow Profits team today and supercharge your real estate knowledge. Build lasting relationships through unparalleled networking opportunities. Obtain lasting knowledge on how to buy multifamily real estate with intensive training. Gain hands-on experience through their live events with like-minded individuals and industry professionals, all while experiencing the personal touch and family atmosphere that set them apart. Visit wheelbarrowprofits.com for more information. And we're back. I like the Google sucks because I think they do suck. But let's talk right now about the vehicles. I like talking about vehicles of investing because everyone thinks that multifamily is the best. I personally do because of the tax benefits, but we're not going to go down that road. It's the best for me. I think single family homes, if you want to buy a few and just want to retire at 15, 20 years later from the equity, that may work for somebody. Mobile home park investing is great. Self-storage is great. Investing and putting money into a whole life policy, letting it mature after 20 years, that's a great strategy. It's not correlated to the market. It's just amazing. That's where people used to put their money before a 401k came out. The majority of people don't understand that. And it's not, and it's that's more for an opportunity cost as well. You're protecting your future with the death benefit, but that cash flow in there can be accessed today as an opportunity cost to invest in other deals. You said hard money loans. I loved the hard money lending space is very interesting because when you're getting 10% in 3 points, you're making 13% on your money backed by an asset with a 65% ARV. Bro, come on. That's a home run. If you don't know what I said, go Google ARV, go Google hard money loans. I think it's an amazing, and maybe connect with Chris. But what vehicles do you like in 2025 and going forward?
And definitely, I tell people all the time, get lean, get liquid, get out, right? So make sure you're being a wise steward of your money, especially as it's coming in. Get liquid means make sure you have liquid cash. Don't lock up in prison. Don't put in equity of your house, like overly more than you have to, right? Don't just try to throw all your money and lock up at IRAs and 401ks, especially if you want to retire before 60. That's a horrible vehicle. That's the wrong vehicle. That's why I teach a lot. You mentioned whole life insurance. I'll use a very specifically designed whole life that we create. I used to refer it out. I could not find one insurance agent that would have the integrity and credibility to minimize their commissions to as low as they can go so that I maximize my returns on my policy. And so we end up doing that in-house. But here's how I use it differently though. I'll keep my liquid cash in there, but I'll keep some of my emergency fund in there to get that 6% tax-free return that's not market correlated, which is nice. The other thing that's really cool too is that I can actually use that money to invest and create passive income now. So like you said, people will say, well, if I don't put it in 401k, where? I could put it in there, use that money now. I don't have to wait 20 years. I could use it like day one with how we design it and use that money to go and invest with. So that's a great place to store money. But then what are my favorite investments? So that's, I mentioned get lean. Now I was get liquid, and the whole life can be a great place beyond using bank savings accounts. Then get out, get my money out to work for me, right? Creating passive income. You mentioned lending. I love lending right now. Really since 2022, that's been really our star, I guess you could say, for our clients because it is good cash flow, especially if you're doing it right. You can make 10, 12+% a year by investing your money in especially short-term lending. Because right now, flips and things like that, like there's still transactions happening. Even though the real estate market is slowed, there's still transactions happening in that front. So that's a great one. And it's a good one for strong, solid cash flow. Probably one of the best right now. You mentioned multifamily. Multifamily, I think you're going to hear not this year, although you'll see people making money this year. You'll start hearing about it as it gets quote unquote hot, which is when you have to get more careful. Probably about 2026, 2027. But I think that we're at the leading edge because multifamily's had their teeth kicked in the last 3 years badly. And so it's finally a place of balance, right? That you're starting to see better deals pop up because more people are just trying to offload and get out of their deals. Versus like self-storage. Self-storage can be good. I don't think it's there yet. So I'm not looking at that. By the way, bonus tip here. ATM funds. I'm getting so pissed about hearing about ATM funds from
I hear that
people.
a lot too. Yeah.
I mean,
It,
there's been so many bad actors or players. I mean, I told people in the first place, one, technology is the worst thing to invest in. Technology becomes cheaper over time, so it does not make more money. Makes less money over time, because people pay less for that technology, and it becomes more obsolete. And if I were going to go into a digital currency, which I know we will, why in the heck would I be putting my money into a cash machine, right? And people say, well, it's still happening. It is, but you're going to see that it's trending the wrong direction. Like I don't want to be trending somewhere where it's going to disappear, right? And I've seen so many people lose money, even though they're like, I got 26% returns. Not anymore. You got now negative 100% returns coming because you just lost all your money, right?
Chris, let me ask you, do you think that people have been, I don't want to say brainwashed, but they've been conditioned? Because we're going to be interviewing Mike Michalowicz, the guy who wrote the book Profit First. So it's very interesting. As I'm looking this and I'm teaching my children, everyone's been focused on the big equity hits. You said cash flowing business. And I think it's so ironic. I always say revenue is vanity, profit margin is sanity, and cash is king. Everyone's thinking about these big home run equity hits. And you don't really hear many people talking about the steady cash flow from these steady businesses. I think that's something that people should really start looking at and saying, I don't really need to hit these big, maybe you need to create the equity and then make that equity go to work. But what are your thoughts on that?
So true. By the way, Mike Michalowicz, great guy, Profit First, great book. We're actually looking to do Profit First for infinite banking. We're actually looking to do a book with him on that. So,
Awesome. Good luck.
but yeah, it is. I mean, I think that's the one thing that when I see a pro forma from anybody, especially in multifamily or any kind of syndication, I'm looking at what's the actual cash flow of the deal, not just what they're paying me, but is it profitable from day one? The whole old model of value add, refi in 3 to 5 years thing, like that's a gamble, a big, big gamble. I want to know, does this property cash flow from day one? Even if we can't turn around and flip it, even if it doesn't appreciate over that period of time, is this deal, does it still work? Does it still pencil? I know you kind of do the same thing when you're looking at a deal, right? Is it profitable from day one? That's what's so important. And same thing with your own money. Again, you can do equity plays that do build and grow. Like for example, I'm in a raw land deal, one of my favorite deals right now, where it's a partnership where they're buying and selling raw land and we're just reinvesting the cash flow right now. I'm not taking any of the cash flow, but we're reinvesting it. $500,000's been invested, but I'm cash flowing about 13,000 a month, right? It's been awesome. Oil and gas, same thing. Oil and gas has a slow burn, but eventually after a year or two, you start to really see that cash flow come in. So everybody has different goals and structures, but I really believe that when it comes to any good deal, the question you have to ask yourself is it profitable today? Not what will it be like in the future? What's it doing right now? And that same thing with turnkey properties, which I used to love a lot and still do love to some level. But again, if it's not cash flowing, don't just gamble on appreciation. That's how I got burned in 2008. Is I was banking on appreciation and I got burned badly. And so I focus on profit, just like you said.
It's interesting. Jake and I always said, if it doesn't cash flow, you let the grass grow. And it's interesting. We're experienced enough that we know if it doesn't cash flow from day one, our pro forma in 6 months is going to cash flow because we know rents are so suppressed. We understand the model, and that's what our model is. We're not buying on a hope that the broker is telling us, hey, rents are going to be $1,300. No, we know because our portfolio has properties in that area where rents are going to be $1,300. So that's very important. But one thing I'd like to say about what you're doing is you're an advanced investor. You can invest for equity because you have other areas. And I love that because you can invest in a deal that has cash flow. It's printing money every month, hard money loans. That's not really building your equity. It's building your cash flow. Then, and this is what we call our conveyor belt theory. You have a conveyor belt in front of you, thinking about an imaginary conveyor belt. It's 5 years. You start stacking assets on that conveyor belt. Within the next 5 years, the assets are going to matriculate. You are able to pull the equity out through a sale or through a refinance and pull that equity back in. If not, you can continue along. Your goal as an investor is to stack assets on the conveyor belt. You're starting to put some whole life, you're starting to put some hard money loans, maybe a single family home, maybe a syndication. As these assets start to pay you off, then you're like, you know what? I want to get into raw land. I'm not going to make money on this asset for the next 3 years. That's okay because I've got other assets that are producing cash flow and capital and money for me to live off of. That's when you start your foundation strong because you got money saved up, you got money put aside. You can take that quote unquote risk or gamble. Don't go do that raw land deal if you've got nothing backing you up and you have no experience. That's the important part. You can start small in a small syndicated deal as a limited partner. You can start small with a small $50,000 loan. It's just starting and then seeing where you like and then learning these different strategies. And what you said about networking is so important. It's important to get out there, go to events, listen to shows, connect with people on LinkedIn, go to meetups, start meeting different people. If you're living in a city, just start asking for referrals from other people. And that's how you start building your network. The conveyor belt theory, though, for me has been revolutionary because that's how we got into syndication. And then we said to ourselves, we don't like investors. We don't want to deal with investors anymore. We want to use our own capital. So when there are syndications, which helped us because we had a capital problem, we didn't have enough capital to invest our own money in our own deals about 10 years ago. You run out of money after a while. That bridged the gap. And then we realized what we really liked. We're like, we like buying deals on our own that are smaller, that we can control. We don't want that. But that conveyor belt allowed us to have the vision to say, oh, put a 20 unit here, 100 unit syndication. That 100 unit syndication in 5 years is probably going to come off the belt, but we have that capital coming back. So I think if you're looking at it from that perspective, I agree with you wholeheartedly. I love the land deals. I love and go back to the ATM machine. The ATM machine was always sold as a tax benefit. I would never invest in a vehicle for the tax benefits. That's like the icing on the cake. You don't invest in multifamily because of cost segregation. That's to me lunacy. Because it's like doing a 1031, I'm saving money on my taxes, but you're buying a deal that's losing money and you potentially may lose that deal. Don't do it just to save taxes. That's the material benefit of it. So if you're looking to make money on the deal and the tax consequences are beneficial, then the deal looks even better. I don't know what your thoughts on that are.
100%. Don't let the tax tail wag the dog, right?
Don't let tax. I've heard that plenty of times. I love that.
Yeah, never let that be the case. Because, I mean, like, for example, opportunity zones. I mean, they were all the craze a few years back, right? Everybody's talking about opportunity zones, but every time I look at the cash flow, I was like, this is horrible. And not to mention, opportunity zones would only delay your taxes to a future date. You still had to pay them later. It was just like an IRA. So it's like there was no real benefit other than just trying to just save money today. It's like, no, you just kick the can down the road and you got into a bad deal. And so I agree with you. The deal needs to be good first. And if it has tax benefits, bonus.
Yes. Chris, where can people find out more about the show, find out to connect with you? Because I think what you do is an amazing service to people who are, they're stuck in the grind. They're stuck making 300, 400, 500 grand a year. And it's weird. They feel poor. They feel like there's no hope. They feel like I'm doing everything right. I'm making good money, but my money's stuck. I want to unlock my money. I want to unlock the equity and I want to get it put to work. Where can they find out more about you?
Money Ripples. Look up anything that's at Money Ripples social media, moneyripples.com, or follow our Money Ripples podcast.
I love that. I'm going to recap the show because I love Chris's story from the very beginning. His father is a saver. He's always saving for the rainy day. Not the sunny day, the rainy day. Don't know why. That's just how everyone says. That's how we all frame it. So saving is already a negative connotation. Scarcity mindset. Gets into the financial planning. He's drinking the Kool-Aid, the red one. He's saying, man, I love this financial planning. But then one day he gets asked a few tough questions. And they ask him, well, how many of your clients are financially independent? And what's going on here? How does this system work? And he's like, this system doesn't work. I don't like what I'm doing here. He gets out of that system and says, I want to start creating income today to make people financially independent. And we didn't say this on the show, but what he's talking about is not retirement. That retirement word was created back in the 1800s by the Kaiser trying to get people out of the workforce to give people, younger people an opportunity for work. That's such an outdated system. The whole idea with Chris's system, if I could, expand upon what I think he's trying to accomplish here, is just trying to give you more optionality, trying to set you free on a path so that if you decide to retire early, you can find what your sole purpose is and start focusing on that and allowing your investments to continue to grow, to continue to outpace inflation, and to continue to really talk about those sacred cows and continue to say, hey, is that really what is going on in today's economy? It worked 30 years ago. Does it work today? And I'm sure in the Money Ripples podcast, he's out there bashing a lot of these concepts and just bringing awareness. And if you felt a little tight or if you were a little triggered throughout this podcast, that's good. That's your croc brain or your primitive brain saying, you know what, I don't like what I'm hearing, but take a deep dive, because I was there years ago, and I would have disagreed with Chris. I would have been like, hey, you know what, I need to save, I need to do my 401k, until I took a step back and I just let my thinking brain, my frontal lobe, say, you know what, there's some truth in what he's saying, because all I need to do is I need to look at the evidence. And when Chris looked at the evidence of Fidelity and find that 35% of them said it was a miracle, so you've got like 0.1% of those people say that they can be financially free, is that the right path? And I love how Chris challenged the whole status quo, and now he's got his own solution. So if you're out there, you're looking to become financially independent before the age of 65, you want to reclaim your time and your financial freedom, hit up Chris. Where can they find you again, Chris?
moneyripples.com, Money Ripples Podcast.
Thanks, brother. I appreciate it. And Jake, miss you, but I think we did a pretty good job. We did a pretty admirable job with you here today. But we'll see you all on next week's Jake and Gino podcast. And I promise Jake will be there. Thanks, Chris.